After a big 2025 for emerging markets, some say they have entered a years-long super cycle. So what countries and sectors should investors focus on? We'll explore this with two of the most credible voices. Franklin Templeton Chief Market Strategist Stephen Dover will be joining the show, and we speak with Mobius Emerging Opportunities Fund Managing Director and CIO Mark Mobius. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. China is pulling the plug on a key advantage held by high-frequency traders. Bloomberg's been told exchanges have ordered the removal from their data centers of servers dedicated to those firms. Mark Carney is holding one of the most important meetings of his 10 months in power. The first Canadian leader to visit China in more than 8 years is talking to President Xi Jinping about cars, food, energy, and security. And several Fed officials signal a willingness to pause rate cuts at their next meeting, citing a U.S. labor market that appears to be stabilizing and lingering inflation pressures. We're showing you live pictures out of Beijing, where Chinese President Xi Jinping is meeting Canadian Prime Minister Mark Carney. Of course, Mark Carney is on a tightrope here, trying to mend ties with China while still trying to regain and restart trade conversations with the U.S. Carney on a mission, of course, to increase trade relations as he looks to double trade out of the U.S. markets in the next 10 years. Key to that conversation, of course, trade as well as security. We know that the Chinese have been calling it pretty much a victory, a political victory for Beijing. Let's get to our Chief North Asia correspondent, Stephen Angle. He joins us from Shanghai. Steve, how significant is this framework agreement on anti-trade? We know this has been signed, and of course, the two leaders are meeting right now.
I think it's quite significant, especially because Mark Carney has repeatedly talked about the historic rupture between Ottawa and Washington, between Canada and the United States, because of Trump's policies and those tariffs. Now in Beijing, when he met with Premier Li Qiang, he talked about this new partnership with China as being part of a new world order. Those are his words, and quite strong words to say that this is a new world order. And clearly, it's been a tone shift from Ottawa towards China, because the last 8 years have been quite difficult. A frosty diplomatic relationship between Canada and China. Back in 2018, of course, they had the arrest of Meng Wanzhou, the executive of Huawei, the daughter of the chairman of Huawei. That arrest at the behest of the United States. And then Justin Trudeau's policies on trade in 2024 essentially were put in line with the United States. So there were 100% tariffs on Chinese EVs to protect Canadian automakers and auto parts makers. There was, of course, also further tariffs on other areas like steel and aluminum. China retaliated in that sense on agricultural products, putting tariffs on a key crop from Canada, rapeseed, which is also known as canola. So these are all areas that these two gentlemen sitting across the table from each other today can potentially ease those tensions, ease those tariffs, reciprocal tariffs, and put the relationship geopolitically on a new footing. But again, there will be resistance if, this energy framework agreement that the two sides agreed to yesterday and essentially inked, that is going to, possibly welcome more Chinese investment in the energy sector in Canada. You already have Chinese oil giants involved in the LNG Canada's project in British Columbia. They're invested in the oil sands in Alberta, but China clearly needs another diversified source of oil and energy because of what's happened in Venezuela. China was buying a lot of Venezuelan oil sanctioned by the U.S. They also buy 90% of Iranian oil, which is now in question, of course, because of Trump's intentions possibly there. So there's a lot at stake, to put it mildly.
And all against a very challenging geopolitical backdrop. What's really on tap in this Xi-Carney dialogue? And I'm just wondering, how much traction can they make?
Well, there's the potential to have a lot of traction because they have walls up on the various key products selling to each other. So there is room to move. And by all indications, yesterday there was a good sense of rapprochement between Mark Carney and the Premier Li Qiang. They seem to both want to find common ground and improve their relationship on a commercial side and also between the capitals. So it looks as though Mark Carney clearly taking a different approach than Justin Trudeau, and there is room for, compromise and improvement in relations. I think, clearly China wants to see that 100% tariff on EVs to Canada to be removed or at least reduced. They've already talked about CATL batteries, possibly even opening up the idea. We're getting ahead of ourselves here, but possibly a EV battery plant in Canada. That's something the industry minister, Meloni essentially said, we're open for business for batteries in Canada. So there are deals to be struck. Let's see how this conversation across the table goes.
EVs and canola oil, the points of contention. Steve, thank you. Chief North Asia correspondent Stephen Angle in Shanghai. Let's get more on Carney's landmark visit to China with Vina Nadjibulla. She is Vice President of Research and Strategy at the Asia Pacific Foundation of Canada, which provides policy advice and business intelligence on Canada-Asia relations. Good to have you with us, Vina. I mean, we know China calls this a political win for Beijing. How does Canada view this visit?
Thank you so much for the invitation, Haslinda. This is a closely watched visit here in Canada, but also in Washington. It's seen as significant. We're already seeing some outcomes. Yesterday, the two sides agreed on a new roadmap for economic and trade relations. It's seen as an attempt by Prime Minister Carney to move forward on his pragmatic foreign policy, to focus on economic relations and sort of put more on the back burner issues around human rights and other irritants in the relationship. But of course, a lot of this will depend on whether or not there are some breakthroughs today on these difficult issues that you mentioned on canola and EVs. But also the other variable is, of course, Washington reaction, because Canada still needs to engage its most important trading partner, which is the United States.
There are two things here, economic engagement as well as strategic alignment. Can you have one without the other? How do you think Carney is managing the two?
I think for Prime Minister Carney, he wants to engage selectively. That's why the focus very much is around laying the foundations for a new strategic partnership on economic and trade relations. That is his language. Of course, that is really different from a strategic partnership in all sectors, including things like defense and security, which Canada has, for instance, with Japan or, of course, with many Australia and with other democracies in the region. That's Canada's objectives. It's easier said than done, because when you become more economically dependent on China, of course, China then wants to have political leverage, wants political compliance on issues that it considers its core, for instance, Taiwan or South China Sea or other elements around human rights. So selective engagement, pragmatic economic engagement on specific sectors like energy is what Prime Minister Carney wants. How to implement that, I think, is going to be a big challenge, and we'll see in the next few months whether that's realistically possible.
We know that energy is a strategic sector. How might the U.S. be looking at this, bearing in mind that Carney is still looking to negotiate with the U.S. and bearing in mind that the U.S. has made overtures about Canada being its 51st state?
Yes, so energy is an area where we're very much dependent on the U.S. Canada sells more than 90% of its crude oil to the United States, and diversifying our exports, particularly to Asia, has been a priority for a number of years, Haslinda. We now have the expansion of Trans Mountain Pipeline TMX, which for the first time last year got Canadian oil to Asian markets, China being the biggest one, but we also now have South Korea, India, and even Singapore buying some of that oil. We have LNG Canada that's allowing us for the first time to sell Canadian natural gas to liquefied LNG to Asia. And there has been a desire to do more of that. I think the current moment, both with the US, but also the changes in Venezuela and Iran, are opening up opportunities. And that is why we saw energy as kind of top of the agenda. We have a separate MOU now on energy. Yesterday, they also announced the establishment of a ministerial dialogue on energy and have signaled that Canada is open not only to export more of its oil and gas to Asia, particularly China, but also attracting investment from China in the sector, which is the area, as you noted, which U.S. will be paying a close attention, especially given their new national security strategy, where they basically said that they will be watching critical sectors and are not welcoming Chinese investment in the whole of Western Hemisphere. So I think that's going to be a delicate balance for Prime Minister Carney to manage. We'll see if there is a reaction from Washington. The ambassador of the U.S. here in Ottawa has already noted that this visit to China is setting the tone for the upcoming negotiations of the U.S., Canada, Mexico agreement. We'll see what that means.
Vina, we know that Carney is speaking in Beijing right now, and he says he's touting, in fact, a new strategic partnership with China. What do you understand by that? What are the implications here? What would be different in that strategic relations with China?
So I think what we're seeing from this visit, that there is a change in tone. We are now speaking about a new era in engagement, so very much moving away from the deep diplomatic freeze that was defining the relationship for a number of years. So there's now a change and a desire to build a new kind of a relationship, focus around these select areas, particularly around energy, around agriculture, around climate technology, and working together to get to net zero. So renewables as well as nuclear and other clean energy. It's a very deliberate effort to work only in areas where national interests align and keep certain sectors, for instance, defense, for instance, dual technologies, AI, still with guardrails and not open to Chinese engagement. We'll see whether that interpretation is also one that Beijing has, because it takes two to tango, and we can only have a strategic partnership if both sides understand the intent behind those words.
Vina, we know that Canada is looking for alternative markets because of a U.S. that's unpredictable, but China is also unpredictable. In the past, China has imposed retaliatory tariffs on Canadian agriculture and other goods. What are the risks here in striking this new relationship with China?
You're absolutely right, Haslinda. We have a track record of China using economic leverage for political purposes when there is a dispute. Canada experienced this back in 2018, but we've also seen this with Australia, with Japan, with others. So the risk is very much there. It's a matter of being clear-eyed about it and making sure that we don't fall into that strategic dependence with China. So doing trade with China is fine. Becoming strategically dependent on them, in other words, selling, for instance, more than 60% of our canola just to China, makes us vulnerable and makes us vulnerable to that political coercion. So diversifying, in addition to China, to other markets in Asia is a critical priority. So China is an important piece, but it's not the only piece. We can't trade our strategic dependence on the U.S. with dependence on China and becoming vulnerable to political coercion from China. Again, that's a hard thing to do, but I think the focus has to be on managing risk, looking at sector by sector where we can do more with China. So energy is one example, because only 2% of our oil, for instance, is now going to China. So there's plenty of room there to grow. But some sectors like canola, we have to diversify, even if we manage to get temporary relief and some kind of a deal on this canola EV discussion.
Right. And Vina, we have more headlines from Beijing. Carney now saying that China and Canada can make most progress in areas like agriculture, energy, and finance. We talked about how, there's still sticking issues like canola and EVs. How do you think these issues can be resolved? Some have suggested that, they can go the European way.
On the EVs and canola, you're absolutely right. So I think they're trying to explore creative solutions whereby we move away from tariffs and look at price floors as well as quotas on how much Chinese EVs can be brought in per year. So I think those are things that can be explored. What we're hearing Prime Minister Carney say again, he's reiterating those sectors, and he's been consistent in saying energy, agriculture, and finance, which is why we also saw them yesterday announce the establishment of a working group on finance for the first time. So I think that is significant, and that speaks also to the personal experience and expertise of the Prime Minister in the financial sector, and the need, of course, on China, and the fact that there's a lot of financial services, insurance companies from Canada already active in China. So it's another area of potential growth. But in terms of how they will manage this, they've restarted the machinery of engagement. So Haslinda, I mentioned that a big development yesterday and today is the change in tone. The second outcome is that they have now restarted machinery of engagement, meaning they've started all these working groups, all these official level ministerial meetings and so forth, and they will be tasked by the two leaders. They will essentially have the political green light and the direction to now work on these issues. And as you know, in the Chinese system, that's very important to have that political level direction from Xi Jinping himself, which is why the meeting that's happening now is going to be critical in the kind of instructions that are given then to the ministers and to the officials to start working in the next few months through all of these working groups that they have set up.
Vina, are there wider implications in the Asia-Pacific region as Carney courts China? How might relations change with other partners in the Asia-Pac region, including Japan, which has maintained a hard stance towards China?
Absolutely. That's a really good question. And as you know, Canada launched an Indo-Pacific strategy now almost 3 years ago, and it had a particular way in which it was describing China and its relationship with others. So if our strategy on China changes, it is natural that that will have an impact on our engagement with Japan, Australia, and others. So I think Prime Minister Carney, in addition to managing domestic interest and issues in managing Washington, also now has to communicate clearly with Tokyo, with Taiwan, with Canberra and others on Canada's evolving policy on China and how it is pragmatic engagement rather than strategic alignment, and how we continue to work closely with Japan, for instance, through the G7 on issues like economic security, supply chain diversification, critical minerals. So it will take some disciplined effort on the part of Prime Minister Carney and his government to reassure allies and to communicate clearly what this evolution in our China policy truly means.
Vina, such a great perspective there. Thank you for joining us today. Vina Nadjibulla of the Asia Pacific Foundation of Canada. Coming up, China is said to be pulling the plug on a key advantage held by high-frequency traders. We'll tell you what this means for global investors. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside, and we want to show you live pictures out of Tokyo as Japan's Prime Minister Takaichi meets with Italian Prime Minister Giorgia Meloni. The meeting is Takaichi's first bilateral meeting with a European leader since taking office last October. Now, we have Yomiuri reporting that Japan and Italy have set to agree on critical minerals cooperation. They're also agreeing on space development cooperation. On top of that, emergency LNG supply cooperation. As you may already know, Italian Prime Minister Meloni is visiting Japan, and she is meeting Takaichi in that visit. And of course, on the screen right now, we have Takaichi making that address in the presence of Giorgia Meloni. Now, Bloomberg has learned that China is pulling the plug on a key advantage held by high-frequency traders. Sources say authorities are removing servers dedicated to those firms from local exchanges, data centers. For more, let's bring in Bloomberg senior Asia reporter Abhishek Vishnoi. I'm just wondering why this is happening. What's the reason behind it?
Well, if you look, world over, not just in China, but even in the US and India, high-frequency traders are making amazing, a huge amount of profits, right? And that's largely because they get better access, better technology. Now, when did better access became, a reason to make an outperformance, a huge outperformance? It shouldn't be. It is about research, time spent in the market, and so many other things that we've learned over the course of different cycles of the market. So, like it has happened in the US, like it has happened in some other jurisdictions, China is doing the same thing. What has happened here is this clampdown on HFTs, them moving their servers out of the heart of exchange is impacting some brokers and some investors who were using these strategies, and of course maybe firms like Jane Street and Jump Trading, etc. But it adds to the headlines that we have been seeing over the last few days of that of margin financing requirements, right, that of some sort of macro slowdown. So it's that accumulation of headlines, I'm told, that is weighing on the sentiment.
In a big way. Is this about protecting the retail investors?
Oh, absolutely.
The way India has done it too.
Absolutely. Locals are buying local markets, and it has never been this bigger for a KPI for politicians or governments to protect local investors. A lot more money is coming into the market. You would remember a year ago, China was trying to actually jumpstart the economy by jumpstarting the stock market. So it goes in that direction. So if you've got a decent local base, like we have seen in India's case, underperforming, but you're doing absolute returns on the positive side, and local money is, making for more than the outflows that we are seeing foreign investors. So it goes in that direction. But my conversations with a lot of traders, a lot of investors, it comes to the point, yes, it slows down the bull market like they want, but it won't break the bull market. It's not in policymakers' interest to do this. And, there is money to be made, and these are very big institutional players. They've got deep pockets. They will find a way. You can put the server outside the exchange, just very close to the exchange, to have the same advantage.
Abhishek, great development there. Thank you so much for that. Bloomberg senior Asia equities reporter Abhishek Vishnoi there. Well, TSMC powering a fresh leg up in the AI rally after that blowout result. Up next, the chipmaker CFO Wendell Huang talks about his outlook for a mega trend of AI demand. Don't miss that conversation here on Bloomberg. Keep it here with us. This is Bloomberg, and we're showing you, of course, live pictures out of Tokyo as Japan's Prime Minister Sanai Takaichi meets with Italian Prime Minister Giorgia Meloni. The meeting is Takaichi's first bilateral meeting with a European leader since taking office last October. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside Global Leaders Reassessing Alliances. We have Italian Prime Minister Giorgia Meloni in Japan, and we're hearing from the Prime Minister of Japan herself saying that they've agreed on critical minerals cooperation, which she says is urgent, and both sides will launch new space dialogue. Of course, we're seeing Meloni addressing her counterpart in Japan right now. Again, Takaichi said earlier that both sides will launch a new space dialogue, and that they will also embark on critical minerals cooperation. Meantime, over in Beijing, we have Canadian Prime Minister Mark Carney meeting with Xi Jinping. He is the first Canadian Prime Minister to hold dialogues with Beijing for the first time in 8 years. We have Xi Jinping speaking right now. He says both sides are willing to work together to improve ties. He says China and Canada have achieved a positive result, and he says that China and Canada is on the path of healthy development. This, of course, against a backdrop of an unpredictable U.S., which is Canada's pretty much our biggest trading partner. We heard from Carney earlier touting a new strategic partnership with China. We know that Carney is walking a pretty tightrope simply because he's also wanting to resume negotiations, trade negotiations with the U.S. Talks have since stalled. China and Canada, according to Carney, can make most progress in several areas, including agriculture, energy, as finance. There you have it. Leaders reassessing their alliances. Now, here's a quick look at where markets stand as mainland China heads to a break and Japan comes back online. The tech-led rally extending here in the region after strong earnings from TSMC eased some worries about overheating the AI sector, but the chip-making giant CEO admits he's still a little nervous as the company ramps up spending.
Essentially, you try to ask yourself whether the AI demand is real or not. I'm also very nervous about it. You bet, because we have to invest about 52 to 56 billion US dollar for the capex, right? If we didn't do it carefully, and that would be a big disaster to TSMC for sure.
Let's get more on the company's earnings now with our Asia Tech correspondent Annabelle Drewlers in Taipei. Belle, take us through those numbers.
Yeah, well, I think the comments from C.C. Wei there were a little bit tongue-in-cheek, essentially. That was the first question that was posed to him during the earnings conference from J.P. Morgan, but talking about exactly how much demand there is and how genuine that demand is as well. And he was saying they've not just spoken with their customers, but they spoke to the customers of their customers as well to try and figure out essentially the scale of the commitment that they should be making. But they're clearly very confident because they've managed to raise their capex to 52 or between 52 and 56 billion dollars for this year. It's a big increase from what we had in 2025 and also a massive jump on the year prior, and they're saying that's going to really be the trend over the coming few years at least. In terms of what else played out in the numbers, I mean, certainly in terms of the sales growth, they're saying that this year we should see it around 30% in US dollar terms, and margins as well, just speaking about the pricing power that TSMC has in the market, plus their capacity utilization. They're saying that margins should actually expand even higher to between 63 and 65%, so well above what analysts had been expecting at 59.6, and also playing into their decision to raise their longer-term margin target to 56%. It's really been stuck around 53% for a very long time or successive quarters. So lots of concrete signals essentially that AI demand is being sustained, and you certainly are seeing the market reaction to that sparked yesterday in Europe, followed into the US, and coming back into Asia this morning.
Belle, we've been talking about trade deals happening as we speak. Meloni in Japan, we have Carney in Beijing. TSMC very much at the center of the trade pact that the U.S. and Taiwan have agreed on.
Yeah, this has been months in the making, essentially, and TSMC wasn't named specifically in the statement, but they are very much at the center of this. So essentially what's been agreed is that the US is going to be lowering tariffs on Taiwanese goods being imported into the States to 15% from the current 20%. But Taiwan has also agreed to increase its commitment to investing in the US by some $500 billion. So $250 billion of that is going to be in direct investments. That includes a pledge that's already been made by TSMC for a $100 billion commitment. Last year they made that. And then in addition to that, $250 billion in indirect commitments as well. So, or additional credit guarantees rather to continue investing in the American semiconductor supply chain. So exactly what that means for TSMC, of course, it was a really big focus when I was speaking with the CFO yesterday, Wendell Huang. They've already made commitments or promises to have 6 fabs in the country, 2 advanced packaging facilities, 1 R&D facilities. But I was asking him, how many more can you add off that, given they've just actually acquired a second site in Arizona? I couldn't get the exact details on that, but I also spoke to him about the tech gap, essentially, and would they be looking to have their most advanced capabilities in the States as well. But here's what he told me.
It really depends on customer demand. In the U.S., a lot of customer wants to go there, so we will expand over there. But for the leading edge technologies, it will be in Taiwan because it's a heavy cooperation between the R&D people and operation people for practical reasons.
And leading edge will continue to be led by Taiwan, you think, over the US market, and that no changes to that at all, even with you adding a lot more capacity in the States?
Yeah, that's for practical reasons.
Is it possible, though, to speed up how quickly that advanced tech can be shifted from Taiwan to the States?
Yeah, we can try to do that, to shorten the gap.
What does that transfer gap look like then? If right now it's several years, Taiwan is ahead, what does that actually look like in the future?
We don't have a specific timeline now, but we can try to accelerate that. We think we can try to accelerate.
Could it be shortened to months, do you think?
It will be difficult, challenging.
Okay, so it stays at least one year behind then. CapEx, it's $52 to $56 billion.
For this year.
Yeah, for this year. So can you tell us exactly how much of that is going to the US, given you've got such a big focus on the capacity build out there?
We don't just break down those numbers, but we do tell people that in the next 3 years, the total CapEx is going to be significantly higher than the number in the past 3 years. So that is evidence of our strong conviction in the AI megatrend.
Our sources are saying, for instance, at least 4 additional fabs could be added in the US, in addition to what's already been pledged. Is that realistic?
It depends on customers' demand. We are looking at very strong customer demand.
Could you give us a number?
We don't have the number now.
Do you want to ask about Intel as well? I'm wondering whether you see any potential for collaboration with the business, given they've got very strong expertise in advanced packaging technology in particular. Could that be an area for you to work on, given you're already outsourcing this to third parties with your constraints?
It depends. If it makes sense to the customers, and also if it makes sense to our wafer business. The advanced packaging business to us is a strategic. It enables our wafer business. So if there are more alternatives in the market which can enable our business, we can consider that.
Would you weigh up investing in Intel just like some of your biggest customers have done?
No discussion at all. What I'm trying to say is it can be considered.
Taiwanese dollar, in our survey of different FX strategists and analysts at Bloomberg, they're actually saying it's going to end the year at 30.9. So what is the impact to you if you see that further sort of strengthening, and what sort of headwind does it represent?
Foreign exchange rate between US dollar and NT does affect our profitability. In the past, for every percentage change in foreign exchange rate, it will affect our margins, gross margins and operating margin by 40 basis points. Nowadays, when the margins are higher, the impact become less sensitive. So nowadays, it's about 30 basis points, either way.
And how are you looking at hedging strategies as well?
The easiest way is to sell US dollar into NT. However, the market impact should be considered. If we're not able to sell all these, then we will do the forward contract. And if we still cannot accommodate all the positions, then we will continue to do moving the US dollar to the offshore entity, which has US dollar as its functional currency.
So FX headwinds may be less of a risk than they were last year when we saw that sudden strengthening in the Taiwanese dollar, but will be really interesting to watch, especially given that size of the trade pact that's been signed between the US and Taipei, and perhaps actually that could be something that brings the Taiwanese dollar under a little bit of pressure.
Good try. He was pretty evasive, but you did really well, Belle. Thank you. Annabelle Jewell is there for us. Now, our next guest says, while AI is a key market theme, she suggests looking beyond the mega cap tech sector and AI builders. Angelina Lai is Asia Middle East CIO at St. James's Place, which manages over $200 billion in assets. Angelina, always good to have you on the show. So move away from Mag 7 and big tech and into small caps when you're investing in AI for 2026.
Thank you for having me back again, Haslinda. Always great to be on the show. Absolutely. So really the key word is rotation, and we have absolutely seen that in the first 2 weeks of this year already. Now let's just talk AI builders, particularly since we just talk about the record-breaking profits that we're just seeing from TSMC. Now, really, when we look into the AI, we absolutely believe that it will continue to be a key theme for 2026. But really, we believe that investors should be looking beyond some of the AI builders. Now, if we look at the AI builders, really the TSMC and NVIDIA, the chip manufacturers, are probably the biggest winners of the AI builders. But if you look above the layers into the AI stack, such as the network providers, they probably earn margins around 20 to 30%. Into the developers layer, such as OpenAI, Glock, etc., who are in absolutely deep losses. This is primarily due to the high capex spend, some of which is due to the high cost of the chips that the chip manufacturers are demanding at the moment, but also the uncertainty of the future revenue generation. However, what we're really seeing as really interesting opportunities are the companies that already have a stable BAU cash flow and revenue generation by using AI as a use case to either increase their productivity and or reduce their costs. We believe these create significant opportunities for international smaller companies, and we're seeing some of that rotation already within the market.
Angelina, we talked about the strong, stellar performance from TSMC. Its biggest clients are the likes of NVIDIA, like Apple. It is a reflection of how they're doing. Why move away from big tech when the numbers support the growth story, when small caps offer their own risks when you invest in them?
And that's a really good point. The risk is the key word, and what we're really looking at is the key tail risks. The economic conditions are currently rather mixed bag. Now, the first 2 weeks of the year, we've pretty much had daily dump of news, geopolitical, Trump changing his mind around whether it's free market or credit card caps. But the market seemed to have just simply shaken that off. But what we're observing is that the market is also very cognizant of the high valuation some of these AI companies are demanding. Really, what we see is that these valuations are not supported by the fundamentals. I talked about the high uncertainties of the revenue generation. Let's take OpenAI as an example. While it has managed some revenue in 2025, a lot of that came from subscriptions, which are still quite low at the moment, and then enterprise deals. But then when you look at the uncertainty of that coupled with potential interest rate sensitivities, that makes the valuations potentially extremely volatile. While we have seen significant support for that last year, we really believe that a lot of that really came from investor enthusiasm. And the problem with investor enthusiasm is that it's sentiment driven. So as soon as you have a potential market trigger, even though we seem to have shaken that off for the first 2 weeks of this year, you could actually be seeing overnight shift from a really supportive enthusiasm into a fear territory. And that's really the tail risk that we're looking at. So what we are really looking at and advising our clients on is to look for more certainty and look for more certainty of that future cash flows. And therefore, we do believe while AI absolutely is a key theme and that will be driving a lot of future returns in the years to come, we believe that more certain cash flows will be coming from the companies that are really using AI adoption as opposed to the highly volatile potential AI builders.
So the advice is to move from mega tech to small caps in the AI space, but we come back to the same argument that this is a concentration risk. How do you look at that?
Well, I've been talking about the concentration risk, particularly in the S&P 500, for quite some time. We've observed really for the last 4 to 5 years the Mag 7 being the key movers of the S&P 500. Now, I mentioned rotation being one of the key words of 2026, certainly starting 2026. For the first time since 2001, we've actually had broad market participation. We've observed just in the first first 2 weeks of this year, 63% of the S&P 500 index actually outpacing the benchmark returns. That's really interesting. It's really interesting investor behavior. It's really that type of rotation, profit taking, but also being cognizant of fundamentals supporting and really the valuation opportunities that we have been discussing for some time.
What are the other attractive assets that you're looking at right now?
Absolutely. The emerging market and the UK are two interesting geographical locations that we're currently looking at. Now, let's talk about EM. Taiwan, obviously, we've just been talking about Taiwan semiconductors, but actually broader place within the EM. 2025, we've actually seen some of the strongest performance across the emerging markets, with perhaps leading with the Korean Cozies, record 75% year-to-date returns. But for us, it's not really about the historical returns. When we look at this, I explained previously, we look at assets from a valuation perspective, as well as whether economically they are being supported, as well as tail risk, as well as the extreme behaviors that we might be seeing in the market. While EM has had a fantastic success story in 2025, we're still finding that the relative valuations, particularly against the US equity market, being extremely attractive. And therefore, we do believe there's still plenty of way to go. That is supported with, economically, we believe, primarily a tailwind supporting for the EM story. With a weakening and actually quite weakened US dollar, that does mean that a lot of these EM, where their debts are in the US dollars, they are having to service less. Essentially, the cost of their servicing is significantly less. And that helps with a much stronger both government as well as company balance sheet.
And that seems to be the consensus for 2026. Angelina Lai of St. James's Place is sticking around. When we come back, we'll discuss the outlook for Indian markets. We stock benchmarks under pressure at the start of the year. Plenty more ahead. This is Bloomberg. Welcome back. You're watching Inside. India's been trading for about 5 minutes now. We're tracking the moves, of course, and among them, we're seeing Infosys rising about 4% after its sales growth outlook for financial year 26 was raised. We're also keeping an eye, of course, on the Indian rupee, which has been a lackluster performer in the emerging market world. The worst performer, in fact, in the last 12 months in Asia. The Sensex, by the way, up about 0.3%, adding to the we're seeing in the region, which is testing new highs. Let's get insights on the Indian market and more. Angelina Lai, Asia and Middle East CIO of St. James's Place, is still with us. She says India's economic outlook looks constructive, but believes stock valuations are still high. That's right. Despite the losses we've seen so far, they're still expensive versus other EM stocks. What do you do with them?
Yes, India is a very interesting market, isn't it? We have seen very strong economic supporting policies. We've seen a strong balance sheet. In fact, the Indian corporate balance sheets has probably one of the least leverage. So we absolutely find some very interesting opportunities there and supportive, strong, healthy fundamentals for us to be looking at the market. That's coupled with quite a lot of things that they have done quite well a couple of years ago, actually ahead of some of the EM pack. That has resulted in a shoot ahead, I think, in 2023 of the Indian market. But really, that shoot ahead, we believe, put India into the higher valuation stead, and that is part of, that is one of the key reasons, really, for the lackluster performance that we have seen. I believe that India was probably the least well-performing of the markets over the EM in 2023 at just around 8% last year, and it's also started a year not great. So really from our perspective is that it's supportive economic conditions, very strong good fundamentals, but really valuations are still really on the high.
For foreign investors, it has been because of the lackluster performance of the Indian rupee. What would it take for that reversal of funds exiting India? What would it take for foreign investors to commit to the Indian market?
That's a really interesting question, and something that I have certainly been reflecting over. And I suspect some of that is perhaps due to there being a lack of big names within the AI development space, given that our discussion earlier around AI still being a key theme of the 2026 market. And when you really look into the AI, while India has some really great tech companies within the space, it certainly is just lacking any of the key names within any part of that AI stack layer. So while we can certainly look for opportunities on a selective basis, the broader market is just not really getting that the sort of enthusiasm due to the AI theme from the market. Taking a look, for example, actually versus China versus US, we've talked a lot about the US AI story, but actually China is really making itself sort of quite strong within the AI stories, particularly within that AI use case, AI adoption story that we have been seeing. I talked earlier about how there's high capex spend and high uncertainty within the revenue generation in a lot of the mega caps, primarily based in the US, and a lot of that is to do with this chase of the generative AI capabilities, which is still really a technology that is quite uncertain, versus how China has been looking at the AI adoption journey and really making AI across the board being possible to be used with all of its companies, within all of its infrastructure, the EVs, the driverless, autonomous driverless taxis, and also making its headways in infrastructure. For example, State Grid yesterday of China has been talking about how it's investing 40% surge into investment into its state grid by 2030.
Angelina, thank you. Angelina Lai, St. James's Place, still ahead. Veteran EM investor Mark Mobius will be joining us with his call for double-digit returns in the Indian market this year. And Franklin Templeton's Stephen Dover will be weighing in on global markets as AI mania roars back. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. We're tracking gains across Asian markets with the regional benchmark headed for a fourth straight weekly gain. Well, the MSCI Asia Pac Index, by the way, set for a fourth weekly gain, and the tech index in particular gaining traction there, particularly where we are in terms of those benchmark. MSCI Asia Pac up 0.3%, driven by the gains in the Kospi, up by almost 1% right now. Not surprising, the TAIEX also leading the pack, up by about almost 2% as we speak. TSMC, by the way, is sending a strong signal when it comes to the outlook for tech. And by the way, we have a headline coming out of Malaysia. Its fourth quarter GDP rising 5.7% year on year. The estimate was 5.4. It has performed better than expectations. Now, a breakdown in the relationship between Asia's stocks and currencies, flashing a signal for global funds to rethink their investment strategy in the region. Asia Equities reporter Winnie Xu joins us with more. Winnie, what's been driving this divergence?
Yeah, it's such an interesting trend that we're seeing right now, right? Yes, it's not completely abnormal when you see this kind of dislocation here and there, but this time at this magnitude, that is quite unusual. You just talked about how Kospi is still rising for the 11th day, and that is being pretty much a top performer globally this year, while the won is at its 17-year low. And this is not just in South Korea, but we're talking about Japan, Taiwan, and even Indonesia. People are talking about different factors pointing to this divergence, but the simplest, answer to this is that the two assets right now are basically dancing to different tones. On one side, you have the stocks rising to record highs driven by that AI optimism. We've got TSMC today, but also on the other side of the equation with currencies weakening, driven by these sector outflows with these trade deals, like just what we had for Taiwan today at $500 billion, as well as in South Korea, but also a series of rate cuts from Asia's central banks and investors trimming their expectations for the the Fed's rate cut. So these are all kind of contributing to what we're seeing right now with this divergence.
I guess the big question is whether we expect this trend to continue further, or might it revert back?
Yeah, so in terms of sustainability, some are saying that it might just be a short-term one, just because there's so much talk right now from authorities in terms of potential interventions. So maybe at this weakness, when it comes to currencies, there's not too much downside from here. And once we get a bit more clarity, whether it's on Japan or the US or Korea on the political front, that would also help with the currencies to strengthen further. And So in terms of that positive correlation between stocks and currencies, we are expecting that to revert. But for the time being, still expecting more volatility, and we are hearing investors potentially considering more hedging, especially considering how a hedging cost right now is actually quite inexpensive when it comes to Asian currencies.
Bloomberg's Asia Equities reporter Winnie Xu, we thank you so much for that. Now, one of the top EM fund managers in the industry is counting on the AI boom to drive more gains. Divya Mathur runs the $1.4 billion ClearBridge Smash Series EM fund under one of Franklin Templeton's specialist investment managers. The fund outperformed some 97% of peers in the past year. Mathur has big bets on chip makers Samsung and SK Hynix, as he expects AI to permanently reshape the memory chip industry, long seen as cyclical and commoditized. Joining us now, Stephen Dover, Chief Market Strategist at Franklin Templeton and head of the Franklin Templeton Institute. The firm oversees more than $1.6 trillion in global assets. Stephen, good to have you with us. It does seem like there is momentum in this EM rally.
Momentum. I'd just be remiss to not mention that ClearBridge is part of the Franklin Templeton family. So thank you for mentioning that fund. There is momentum like we haven't seen in a long time. When we talked last year, I had recommended for our global investors to, while we were very positive in the United States, to be overweight emerging markets and to be overweight international stocks. I think that that momentum is continuing. I haven't been in a situation where two different things are going on. As you've seen with so many interviews of the different strategists from different places, there's probably more enthusiasm about 2025. There aren't very many strategists out there that are actually negative. But we're still in a situation where most, certainly American investors, but also global investors, are heavily underweight outside of the United States, overweight in the United States, and they're very underweight emerging markets. My history has been as a global investor, and it's somewhat been disappointing to me the last few years. Everybody wants to talk to me about the United States, but now there's much more interest in emerging markets, and particularly Asia.
Might we see a broadening? A lot of the conversation has been around AI and tech, even in EMs. I'm just wondering, with a weaker dollar, with healthier valuations, in fact, cheap valuations, could we see a broadening in 26?
So our major theme is broadening within 2026. It was somewhat our theme in 2025 as well. So within the United States, we think we're still positive on AI stocks, but we think that what we're starting to see is AI get into the economy, get into the broader companies and increase productivity. So we see the investment opportunities broadening within the United States. So we're recommending more broadening, smaller caps, a wider set. Now, we move that further to other markets outside of the United States, and we continue that theme. So we're banging the table, as we did last year, for global investors to increase their exposure, because as I said, I think they're underweight outside of the United States. And our best ideas are Japan and emerging markets at this point. And within emerging markets, we are positive on emerging markets, both in terms of from a fixed income perspective. Last year, emerging market fixed income was a great outperformer as well. That's a sign of broadening too, right? That the currencies are quite broad. Emerging markets markets have been much more responsible in some ways with their economies than the developed markets, particularly this last couple of years. And that's a broadening theme too. So we're looking at emerging markets from a very broad perspective. Yes, we have funds like the ClearBridge Fund that really focuses more on the AI and have had great performance. But overall, we're quite positive on emerging markets as a broad investment theme.
You're banging the table. We sure hope people are listening. Do you buy the dip? What indicators are you looking at to suggest a good entry point?
Well, it's tough, and that's why there's so much cash sitting on the sideline, especially with AI stocks. I think that first of all, people might want to look at reallocating their investments from probably being overweight the United States, probably being over AI. It's not that we don't think AI is going to do well. It's just that it's a risk of concentration. And it's a reason we think that people should move more to emerging markets. And then, yes, we're positive on the year ahead, couple years ahead, but it's going to be a rocky road. We're not going to be surprised if we see a pullback of 10%. In fact, we almost always see that in election years, in between presidential election years in the United States. Almost all the time, the market goes down during that year and then ends the year positive. So certainly entry points are any correction. But for most investors, they've been sitting on the sidelines waiting for the market to correct. And that's probably the wrong approach. Probably consistent, what sometimes is called dollar cost averaging, and just working your way into the market is probably best, because my guess for most investors is they're underweight outside the United States and particularly underweight emerging markets.
How closely are you watching central bank policies? Expectations are that the dollar will remain weak. Expectations are that the Fed will cut, whether it's 1, 2, or 3 times. And we're talking about that policy divergence. How are you looking at that? How do you play that best?
So we're playing that both on the fixed income side and the equity side. I think that unfortunately, the United States Federal Reserve and monetary system has lost some absolute credibility, but also relative credibility. And that's why there's been a flight to hard assets, gold particularly being an example of that. There's more uncertainty in the United States. I sometimes in the past have expressed some uncertainty about emerging markets or China. But right now, those countries on a relative basis are more responsible than the United States. We don't know for certain what's going to happen in the United States with monetary policy. Certainly the situation with Chairman Powell this last week, having an unprecedented attack on him, but making an unprecedented response to that is something we really have to look at. And it creates an uncertainty. Last year, we thought the dollar would fall. It didn't fall as much as we thought. This year, we don't have such a strong view on the dollar. We don't think it'll rise, but we're not really looking for a big fall in the dollar. And we think the markets can outperform without that. Now, if there is going to be relative performance versus the dollar, we think that'll be in emerging markets. So we're still very positive on emerging market debt.
Emerging market is looking attractive, but you say the U.S. is still the place to be. I just want to quote what you said, that they have superb fundamentals, superior profitability, options unmatched anywhere in the world. So when you talk about this rotation, we've seen this rotation from the U.S. to elsewhere in the world, especially in the U.S., from the U.S. to Asia to EMs. Are they wrong in doing that if the U.S. remains the place to be?
Well, it's not just earnings and economic growth. It's actually pricing as well. And the United States is still expensive relative to other markets, including emerging markets. And we actually think that emerging markets are going to have really strong growth this coming year. And I keep reemphasizing this point, but there's been a dramatic increase in overweight in the U.S. When I first started managing global funds, the U.S. was 40% of the global benchmark. Now it's close to 65%. I just don't see that relative growth happening. And I think there are just a lot of opportunities outside the United States. And I would just encourage investors to think of risk-adjusted return. And that there's probably less risk diversifying your portfolio outside the United States. I think you have Mark Mobius talking after me. And one of the great things Mark did for emerging markets is really show that investing in emerging markets can reduce the risk of your overall portfolio. And that's what we believe as well.
So the theme has been rotation from the U.S. to Asia, somewhat also rotation out of big tech, mega stocks to small caps. I'm just wondering what your thoughts are on this, because small cap stocks also seem to be highly leveraged. Therein lies the risk.
Yeah, small cap stocks are a place that you really have to differentiate the stocks. I don't think as a category you want to just go into small caps. At least in the United States, half the small cap stocks are not even profitable. So which half of that benchmark does well is very much dependent on a risk and risk off trade, and very much dependent on stock picking. That said, we do think that there's a lot of tailwinds in the economy, particularly the U.S. economy, but really globally, and that is going to be that broad upswing for the economy is going to be popular for small cap stocks, which have dramatically underperformed bigger stocks for quite a period of time over the last 5 or 10 years. So there's a lot of catch up there that can do with those smaller cap stocks. So we think that's a place, once again, most people are underinvested. There's a lot of opportunity. That's a stock picker's market.
Stephen, I want to focus on China a little bit. It's gone from uninvestable to an outperformer. In fact, Goldman says it sees a 20% upside for China this year. Are you as upbeat, and what's fundamentally changed? Is it just about valuations, or have China's fundamentals really made a shift?
Well, I always thought it was a very crazy question. I've been at China, I've been in China now over 30 years, every year. And I've always just thought, China uninvestable was sort of a silly thing to say. That said, I think there's a higher risk premium in China, particularly for foreign investors. But that whole idea about China being uninvestable and the money fleeing of that, a lot of it not because of investment decisions, but more because of political decisions, created a great undervaluation and an underappreciation for China. So I think certainly in the short term, that's why China's performed so well. A combination of China doing a bit better than expected, but mostly because investors had abandoned China. So we're not probably the biggest interest we have in emerging market funds are emerging market ex-China, or at least emerging markets ex-China, except for the AI companies. We're still positive with select companies in China. We're just cautious. We think there's a greater risk premium there.
And Goldman says that the rally in China will be pretty much driven by earnings. Do you share that view?
Yes, we do share that view. And, earnings surprise on the upside. I think if you were really to look at the risk around AI for Western companies, is the hubris that the Western companies are really leading AI. And I think we've seen that a little bit over the last couple of years. But I think China has a different model for how it's approaching and implementing AI. But I think it's a real competitor, and I think it could inflate. It is one of the risks, and it could inflate the Western model of how the very expensive Western model of approaching how AI modeling is done.
Is there anything else that investors should be looking at in China that's been, I guess, underappreciated?
Well, we've always thought the other area that's underappreciated in China, and it hasn't had the growth that we expected, but I think there's still a lot of opportunity, is the consumer. And ultimately, China is going to need to turn towards a model to increase consumption. China now has world-class consumer companies that are incredibly competitive in China, especially China consumption growth, but are competitive globally. And I think that those companies in that area is probably underappreciated.
The thing is, China has struggled to reverse that consumption story. It's gone on for quite some time. It is understandable why people are reluctant to buy into the consumption story in China.
It's very understandable, but like you said before, it's also a very undervalued area. So it doesn't have to perform very well. I think that's the model when we look at the United States. Yes, it looks like the U.S. is going to grow. Yes, it looks like those AI companies are going to do well, but they're priced for that as well. Whereas there's no love affair with China right now. It's up, but there's not a lot of flow going into China. So it doesn't take much for China, or if you want, we could talk about India right now. It doesn't take much for them to perform very well because there's not the expectation that they will. That's what happened with Europe.
Let's talk about India. It's been a laggard. India has been a laggard, yet many investors are still optimistic about the longer-term prospects of this market. Oh. How long do you wait, and what's really holding it back?
Well, I was just in India last month, and long-term and structurally, I'm just a real India bull. I've been an India bull for probably 20 or 25 years. But India's always been expensive, and kind of a bad joke is that India gets in its own way. So I think India last year was just kind of deflated. It didn't have the growth that was expected. It didn't have the capital investment that was expected. But we're not looking for a real strong year in India. India hasn't gotten off to a very good start so far. But particularly if there's any fiscal stimulus, we think India will do better. India is starting to have some more capital expenditure. If that happens, India will do better. And India is just structurally, with the support of the government, structurally, I think, going to be able to have an awful lot of growth. I think the exciting thing for me, having been in emerging markets for quite a while, let's say 30 years or so, and watching the difference in growth between India and China, is that China's done such a phenomenal job on its economic growth, and India has a lot of catching up to do, and it has the possibility for greater growth over the next 5 or 10 years that say I don't think China does, because China's already done that.
So, Stephen, if you believe in India's long-term story, its long-term potential, can you justify the premium that India commands today? Would you be a buyer at current levels, or would you be waiting?
We would be a selective buyer of some industries within or some industries and companies with India. One of the most exciting things to me about India is that for a very long period of time, it's still a market where stock pickers can outperform. And that's just, it's just not so true in terms of the efficient markets like the United States. And so that's, I think, where there's an opportunity. I wouldn't be really underweight India in an emerging markets portfolio, because it is going to outperform over the longer term. And we tend to have a longer term outlook. And it's times like this. I mean, when I look back 25 years, there's maybe, 4 different times where people aren't very positive on India. And if you got into India in any of those times, you did really well the next few years. And this may be that many times. I mean, I don't know how many people you've talked to, but I don't think strategists are really enthusiastic about India right now. And to me, that means it's probably a little bit of an opportunity.
So if you take a look at your EM portfolio, how should India factor in? I mean, we know that when it comes to Mark Mobius, he's talking about 20%. He's looking at getting to 30%. How much should India be factoring into that portfolio?
30% of the portfolio. we're probably not as high as that in terms of percentage of the portfolio. You have to realize Franklin Templeton now is so big, and we have a lot of different emerging market managers who have different views. So the ClearBridge fund that you just mentioned is looking at emerging markets in India really from a AI perspective. But for me, and the view that I take, kind of looking at a very broad set of investment opportunities. I think there's a lot of opportunities even in fixed income in India. I think there's opportunities in private investments in India. Private debt in India has a lot of opportunities. There's a huge spread there. But the real opportunity in India, as I mentioned, is I think it's an inefficient market. So I think there's still opportunities there for investors who are willing to do the work and really make picks. And then if you do that in an emerging markets portfolio, I would at least, I'd at least equal weighted, if not overweighted. I am overweight India, personally.
Are there reforms, policy changes, and steps that the government and authorities can take to make the Indian market more attractive? We know that foreign funds have been making exit, but that's mainly to do with the weakness in the Indian currency.
Well, foreign funds, perhaps, and that's a currency issue. But I think the Indians could make it still a more friendly investment environment for foreigners. There's still work to do on that. I think that probably rightly, the Indian government has been hesitant to do a lot of fiscal stimulus, but I think it probably needs to do a bit more fiscal stimulus at this point. And it just needs to be more friendly towards capital investment. I think that there's a lot of interest, of course, in AI right now, but there's also interest in just general other investment opportunities. And I'm guessing over the course of the next year or two, there's going to be a real surge for opportunities outside of AI. And I think that's an area where India, because it has such huge infrastructure needs and such huge growth potential, I think that India can be a diversifier investment opportunity for those who are global investors.
Stephen, I want to zoom out right now. You're a global investor. You have a global footprint. If you take a look at the macro environment with rising geopolitical tensions spanning the Middle East, Venezuela, even here in Asia, I'm just wondering, are investors underpricing risk right now, shrugging off all the various developments when we're seeing new headlines every single day, taking, the markets by surprise, but even then, that's not enough to move, their risk appetite?
That's a great and in some ways a little bit of a profound question in my view, because as a mostly long-term equity person, I was mostly focused on companies, and I think most equity investors are mostly focused on companies and what we call bottom-up, and then maybe some top-down economic, but not particularly interested in geopolitics. Perhaps it's because of this role I have now, but I noticed that there's been a dramatic increase in the need to know what's going on within geopolitics and how that's moving markets. So I think the way that investors have to look at the world has to be through geopolitics. Now, here's the really bad news. The really bad news is investors have no way of knowing how to price in geopolitical events. They just have a terrible track record. And that's the concern. And if you were to look at the headlines, you would not say the market is performing in the way that it is. It doesn't make sense. It doesn't. There's a mismatch there. And I think that's a risk. But it's unfortunately a risk that's very difficult to price into valuation models.
Stephen, such great views today. Thank you so much for your time. Stephen Dover, Chief Market Strategist at Franklin Templeton and Head at Franklin Templeton Institute. Now, coming up, hear why veteran EM investor Mark Mobius sees India's growth potential outshining that of China this year. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. China's economy may have capped 2025 with its weakest quarterly growth in 3 years. Beijing is set to release GDP numbers on Monday. We'll also get December activity data expected to show a historic contraction in investment and faltering consumption, offsetting the gains from an export boom. Let's bring in Bloomberg economist David Chu. David, how are we assessing given the data we're getting right now?
We have, when we look at the high frequency data so far available for Q4, we think that the signals are quite clear that the demand side is still weak and maybe even weaker than the last quarter, although the production side is still resilient. What we are looking at, the first is the fixed asset investment. We expect it to continue to drop in this quarter, so that it will drag the full year growth of the GDP. In addition to that, the consumption side should also weaken from the previous quarter. One of the reasons is the rollback of the government subsidy to home appliance and also smartphones. So all in all speaking, we think the weakness will be more reflected in the demand side, but not the production side.
As you said, consumption will get worse from here. Is that enough incentive for China to perhaps revert its policy, provide greater stimulus?
Well, so far, yes, of course, we expect the government to give more stimulus or support to the economy. But if we look at the consumption side, the government, the fiscal side, give us continue to with the subsidy for buying home appliance and IT product, but we think that is not enough. We have a view that the subsidies could expand to cover such as consumption services, so that to better support the consumption, which is a main drag to the economy. And we think maybe the government can have a look at this.
David, thank you. Bloomberg economist there, David Chu. Let's get perspective from Mark Mobius, Managing Director and Chief Investment Officer at the Mobius Emerging Opportunities Fund. Often described as the guru or even the godfather of emerging markets, he brings decades of experience and insight into global investing. He's also the co-author of the new book, Digital Currency Revolution. Mark, always good to have you with us. We heard from David earlier about how China's economy is showing signs of weakening further. Yet when you take a look at the stock market, it is a different story. The MSCI Asia Pac Index for China was actually up 28% last year. Shanghai Comp up 18%, and we're seeing continued gains in 2026. It begs the question, is it sustainable?
Yes, it is. You must remember the stock market looks forward. It's not looking backwards. And the stock market is telling us that what China is doing in the technology sector is going to be very exciting going forward. It's interesting to note what we just heard about China not giving enough money into the consumer sector. But where that money is going is into technology. You must remember, China's goal now is to overtake the US in technology, in high-level chips, in all kinds of AI. So the money is going in that direction, not in the consumer's direction. And the government doesn't really care much about what's happening on the consumer level, as long as things are relatively peaceful and people are not going to start rioting on the streets. So the money is going in that direction. And the market is telling us that some of these tech companies in China are going to be quite exciting. So this is the kind of thing we've got to look at.
They may be exciting, but will they impact the economy in a significant way? Are they able to reverse the growth story in China?
No, they will not. Because, as you heard, the way to revive the economy is by pushing the consumer sector. In other words, becoming more like the U.S., where the consumer leads the economy and grows the economy. That's not going to happen in China. The emphasis is going to be on industry and technology.
and that will not be reflected immediately in the GDP figures. So you won't see the kind of growth that we, have been seeing in the past. Of course, in addition to that, generally speaking, we're never going to see the 7-8% growth that we saw in the past, simply because the population is older, population is smaller than it was before, and you're not going to see that kind of dynamism that we saw previously.
Mark, aren't there risks in investing in a market when fundamentals are in question? We talk about consumption, which should be driving growth. We talk about the property sector, which is struggling to get revived. I mean, these are key sectors in the economy. Aren't there risks in investing in China when fundamentals are not quite intact?
Yeah, there's a risk to investing in the property sector and in the consumer sector. You want to stay away from those sectors for now. But the technology sector is a different story. That's where you should be looking. And it won't be reflected immediately in the GDP figures. So the macro picture will not be a good indicator of where you want to go in China. You want to look at the technology sector.
What are you seeing in terms of fund flows? We've been talking about how there's been a rotation from the U.S. to Asia, particularly to China. What are you seeing?
Well, I think, first of all, yes, it is true that people are diversifying away from the U.S. market, mainly because the U.S. market has done so well and they've made so much money. So there's a lot of money sloshing around looking for a home. So anybody who wants to have a good portfolio wants to be diversified. So what's happened? They've seen their U.S. portion of their portfolio growing very fast, and the international portfolio has not gone so fast. So now they're shifting more into international markets. And of course, if you look at international markets, you got to look at China, number one, and then India, Korea, Taiwan. These are the markets that, and by the way, those markets are doing quite well, as you know.
Is China also benefiting from all the geopolitical developments we're seeing in Latin America, in the Middle East?
Actually, China's not doing too well in Latin America, as you know, with the situation in Venezuela. Of course, China is the largest exporter, for Latin America being the largest importer of Chinese goods. So that's helped a great deal. They've diversified their network of export hubs. But at the end of the day, the growth is going to be in, as I mentioned, technology, and particularly as the U.S. situation becomes more normalized, the U.S. will still be buying more and more Chinese goods, directly or indirectly.
We know that you're big on India and China. What are the other emerging markets which might show potential? I mean, we talk about Brazil, Argentina perhaps being the next wave of growth. Are you still holding that view?
Vietnam comes to mind immediately. Taiwan is looking very good. Further down the road, perhaps Brazil, but Brazil is now going to be going through political change, so it's a little bit of a question mark there. And those are the main countries that I would say stand out of what we want to be looking for.
Some people were talking about Southeast Asian economies just last year. We have the likes of Thailand holding an election next month. We also have Indonesia struggling to revive its growth. How are you looking at some of these Southeast Asian economies?
They're doing fine, but they're not going to be very exciting going forward, simply because their export push has not been very, very good. And at the end of the day, their government structure has not allowed them to focus on various industries. Whereas in the case of Vietnam, the government has been very amenable to technology growth and to export growth and to taking over a lot of the manufacturing that was done in China.
Mark, Of course, the other theme in the market right now is precious metals. We've seen quite a run for the likes of gold and silver. In fact, silver gained 20% over a course of 4 days. And we have the likes of JP Morgan saying that gold could get to 5,000. What's your take on precious metals in 2026?
Everybody's excited about precious metals. I get questions every day. People, should I buy silver? Should I buy gold? When should I buy, et cetera, et cetera. At the end of the day, I think it's gotten too hot. In fact, just the other day, someone asked me, should I buy silver now? I said, look, it's possible that it'll go much higher than it is now, but no one really knows. And it's very, very volatile. So you've got to be careful when the market is so hot. But there's no question there are lots of arguments for silver and gold to go much higher than they are now. A lot of it is linked to a weaker U.S. dollar. A lot of people think that the dollar will get weaker from where it is now, but that's also a big question mark because my thinking is that probably the dollar could turn around and get stronger from where it is now. As the predictions regarding the U.S. economy say that the economy will turn around and GDP growth in America will be much better this year than it was last year. If that happens, then the dollar will get stronger and the precious metals will not be attractive.
People talk about how gold is now a diversifier, not just a haven play. I'm looking at gold right now, easing somewhat. At what level would you be picking up gold again?
I would not pick it up at this level, that's for sure. Maybe 20% lower from where it is now, but I would not run after gold at this stage. As you know, in the past, I said you should have at least 10% of your portfolio in gold. Now, of course, with the rise in price, it's probably gone to 15% or more. So maybe it's a good time to take some profits.
And how much cash are you holding in your portfolio?
We're having about 20% in cash now. The markets are pretty wild, pretty high, and I think it's a good idea to reserve some cash.
Mark, hang tight. Mark Mobius of Mobius Emerging Opportunities Fund is sticking around. When we come back, we'll turn our focus to India and discuss why he's predicting strong gains for the market this year. Plenty more ahead. Keep it here with us. This is Bloomberg.
The India growth trajectory is very much intact, and from an opportunistic standpoint, if you are willing to take some volatility because the tariff overhang kind of remains for the time being, if you can play it in the next 3 to 5 years, that's where I see India as a great place in terms of taking that exposure as well.
We have changed our position towards M&A. Now we declared the market will be more acquisitive going forward.
We think the tech spend is going to be a very important component.
There will be tailwinds coming from, a weaker currency for India, which sort of helps the IT sector.
We are looking at a number of opportunities where we can improve our competency either in a technology or in a business domain.
Some of our guests this week discussing the outlook for Indian markets and the tech sector. Here's a look at how Indian markets are performing about 45 minutes into the trading day. It is extending the gains up by 0.6%, pushing the MSCI Asia Pac Index even higher. It is currently at a new record high. We're also watching Reliance Industries ahead of the Indian conglomerate delivering its latest earnings results today. Analysts expect a 4% rise in third quarter profit, fueled by its refining, petrochemicals, and telecom divisions. Investors will be on alert for a potential impact on Reliance's refining business from curbs on Russian crude imports. Well, Mark Mobius from Mobius Emerging Opportunities Fund is back with us, and we know Mark is an India bull. He's been an India bull for a very long time. Though, Mark, India disappointed last year. Will it be different in 2026?
I think it will be different. As you see, the market is now doing very well, and I think it will continue to do well. But I take a longer view about India. India has lots of problems. The bureaucracy is slowing down the economy in many, many ways, but still, despite that, the growth has been tremendous, 6-7% growth. Now, Modi, I think, is taking measures to curb the bureaucracy and to try to open up the economy more and more. Now, as that takes place, you're going to see more momentum, more push to increase spending and investment, particularly in the tech sector. So I think that's going to be a very exciting story going forward for India.
It is exciting, but it will take time. Some say 3 to 5 years. Yet, you're forecasting returns of what, 12 to 15%. What would take us there?
First of all, consumer spending. As you know, 1.2, 1.3 billion people, most of them below the age of 30, young population, increasing urbanization. This all feeds into an incredible consumer market. That's number one. Number two, the employment in the electronics industry will be increasing very rapidly. I believe going forward, India will become a major producer of semiconductors. Now, that sounds far-fetched at this stage, but there's no question that they have the capability to become a major semiconductor producer. And they must do that because they must catch up with China and the U.S., given the incredible population they have, and given the fact that they're becoming a major exporter of electronic products.
So how do you position to reap the benefits in the future in the semiconductor, in the tech space in India? What would you be buying now to capitalize on the low valuations?
Well, first of all, as you know, many of these semiconductor startups have not been listed yet. So it's difficult to get exposure in that direction. But you can get exposure in the software area. You must remember, a lot of the chip software is already being produced and done in India. So we're looking at companies that are in that space. That's one area. The other area is companies that are just simply now assembling and manufacturing consumer electronics, and they're going to be going upstream into more sophisticated components. So that's another area that we want to look at.
It's hard not to compare India and China. Despite the fantastic run China has done, you say that India remains the top market even for the foreseeable future. Why is that, Mark? What's driving that optimism?
Well, first of all, the size. The size of the country is incredible, number one. Number two, the youth of the population, number two. Number three, the fact that you have an incredible absorption capacity of technology from all over the world, because you have an English-speaking elite group of people very well educated that can absorb this technology. As you know, if you go around the world, you see Indians trading in every direction and doing a lot of tech work. So all of these components are coming together and having an incredible impact on what's happening in India. And you must remember the other point with India is that it's open in the sense that you have a very open economy. You have states, the different states competing with each other. This is very, very good and very, very prosperous when you think of it, the growth going forward.
As you wait for India to perform, how do you navigate the headwinds? Currently, we're seeing a rupee that's among the worst performers in the Asia-Pac region. We also have uncertainties to do with the trade pact with the U.S. Modi and Trump are not getting on too well. I mean, how do you navigate all those uncertainties?
The Trump-Modi situation looks bad, but actually is not as bad as you think. As you know, Trump says many things that he doesn't mean. It's purely bargaining that's taking place. And I tell you, frankly, you don't want to go up against India when it comes to bargaining, because the Indians are terrific bargainers. They know how to bargain. So I think this is a cat and mouse game that will go on for a while. But generally speaking, trade with India and China will, India and the U.S. will do very well. And by the way, trade with India and China will also do well. So I think India is open and very good in terms of international trade. The interesting thing about India going forward is that they're going to be doing a lot more consumer electronics growth when you look at what's happening and how a lot of this manufacturing is being transferred from China to India. That's going to be a very exciting thing. And of course, a lot of that product will be going to the U.S.
Mark, given your love for the Indian market, I'm just wondering, what's the weightage of India in your EM portfolio? Is it still at 20%? And are you still targeting 30%?
Yes, we're at 20% now, and depending on what we can find, we'd probably go up to 30%.
How do you balance, I guess, the concentration of your portfolio in India while still wanting to diversify to protect that portfolio?
Yeah, but you must remember, within this 20%, we're very diversified across many industries, different industries in India. So in that sense, we're getting diversification. And it's true that you've got to be careful when you're having a portfolio. You want to be diversified, but at the same time, you want to have that growth. You want to have that performance. And the way to do it is going into areas that are growing fast and that are expected to go fast.
In our early conversation, you did talk about the Adani Group. You talked about how investing in Adani is investing in India. Is that still the case? And how are you looking at this company and the prospects going forward?
Well, when you invest in Adani, you're not only investing in India, but you're investing in infrastructure globally because, as you know, they're very much of a global firm. They're doing things all over the world. But I don't want to emphasize Adani too much because you've got Reliance, you've got a lot of other great companies in India. We won't be putting all our eggs in the Adani basket. You've got to look at so many of the other companies, and particularly the software area is very exciting for India. So Adani will do well. They're a very exciting company, but at the same time, there are many other players that will be doing as well, if not even doing better.
What is the one Indian asset you must hold in 2026 for the best returns?
I would say to begin with, you have to look at, I don't want to mention an individual company, but I would say you'd have to look at the consumer sector to begin with. Retailing, consumer goods, that sector would be probably the most exciting at this stage. But going forward, you got to start putting some of those into the consumer consumer technology sector.
Mark, always a pleasure. Mark Mobius, Emerging Opportunities Fund Managing Director and CIO. Now, before we go, here's a look at some of the big names we'll be speaking with next week from the WEF in Davos. We'll talk to government officials, including the finance ministers of Japan and Hong Kong, CEOs from across corporate Asia, and leading investors. Join us, if you can, for those conversations starting Monday. That is it for Insight Horizons Middle East and Africa. It's next. Keep it here with us. This is Bloomberg.